Unit 22, break-even analysis. Break-even technique is widely used in production by production managers and management accountants. The technique is based on categorization of production costs between those which are variable and those which are fixed. Recalling, variable costs change with the level of output. More the output activity, more the business activity, more the variable costs. Fixed costs are not directly related with the level of production activity. Whatever be the level of production, the fixed costs had to be borne by the business. Break-even analysis or a profit contribution analysis is a technique used to make managerial decisions with regard to relation between total revenue and total costs and total profits. Managers often use it to determine the sales volume required for the firm to break even, that is, where they are not making any profits or they're not making any losses. Total profits and the total losses here just about cancel each other. And further, they assess what will be the likely profits or likely losses at various levels of output. Assumptions of the break-even analysis or the break-even point. Some of them may not be true in life, but however, it's a very useful tool, but keep these assumptions in mind. Here, we are assuming that all costs are either perfectly variable or absolutely fixed over the entire period of production, which in reality may not be the case. Volume of production and volume of sales are equal. In reality, it may not be so. You are always left with stocks. Third, all revenues are perfectly variable with physical volume of production. That means it's a corollary to the previous one, where we are assuming that volume of production and volume of sales are equal, which is not so. And the last assumption here we're talking about is product mix is stable. Again, not very true in the business life, business activity, but these assumptions are essential to progress or learn the analysis by break-even point. Contribution margin. The contribution margin is gathered from the break-even charts. They measure the contribution of business activity towards covering the fixed costs. Average contribution margin, ACM, is different between the unit price, is the difference between the unit price and the average value variable costs. Total contribution analysis can also be used to determine the total contribution profit. Contribution is the difference between the total revenue and the variable cost. That part of the revenue which is over and above the fixed costs, after covering the fixed costs, that is your contribution towards covering the variable costs. What are the uses of break-even analysis? Number one, optimum level of output can be estimated by this technique. Number two, plant expansion and contraction decisions are often based on break-even analysis. Number three, profits and losses can be forecast from estimates of revenues and costs at various levels of production. 4. effect of change in volume of sales, prices, and cost of production can be analyzed. 5. Help in product mix decisions. Break-even point or break-even analysis can help us in deciding what product mix to go in for. 6 is the effect of fixed costs and variable costs is better determined by break-even analysis. Then, better planning for cash requirement can be made when we know the various volumes, the various revenues expected, and various costs estimated or various levels of production. What is a break-even point? Break-even point is a 0 point that we discussed earlier. So it is fixed costs divided by the selling price minus the variable cost per unit will give us the break-even point. Example, say the fixed cost is rupees 10,000, selling price 5 per unit, variable cost 3 per unit. Therefore, break-even point is 10,000 divided by 5 minus 3, that is 5,000 units. 5,000 units will be the point at which the manufacturing unit would not make any losses or profit, and it is breaking even at that point. More than 5,000 is desirable and will be making profits. How much profit at the various volumes, or if that volume is not achieved, what is the loss type of a loss we'll be suffering can be calculated from break-even analysis. So, methods of break-even analysis. One is geometric method of break-even chart is prepared. The second one is the algebraic method. Here's an example of a break-even chart. This break-even chart, like all other charts, the vertical axis is giving us the price, money, and this is the horizontal axis is measuring the quantity sold. These are the fixed costs. You are very familiar with this. Fixed costs, that is, the costs do not change at any level of production. The revenue is 0 to start off with. At the origin, we are selling nothing, we are getting no revenues. And as we are selling more and more quantity, the revenue is increasing. A straight line linear function, which means that it is the price is sold, all volumes are sold at the same price. Now, point to note here is that your total cost is not starting at 0. At 0 production, your total cost is fixed cost has to be covered. This is the cost whether you are producing or not producing anything. So total cost will start from fixed cost onwards. At 0 production, total cost is this much. It's not 0. Whereas the revenue is 0. So this shaded portion here, this one, is loss. Here we are not recovering whatever is the cost. The revenue curve is below the cost curve. This is the break-even point where total revenue is equal to total cost. Beyond this, we are making a surplus, and that is this shaded area. This is the total revenue, this is the cost, and this much is the profit area. This is the profit. This is the total variable cost, this is the fixed cost, and it comprises of the total cost. That is the linear explanation of a break-even point. Break-even analysis. Break-even analysis is a examines the short-run relationship between changes in volume and changes in the total sales, revenue, expenses, and net profit. It is also called cost volume profit analysis, CVP analysis. Uses of this analysis. Cost volume profits analysis is an important tool in terms of short-term planning and decision making. It looks at the relationship between the cost revenue output levels and profits. Short-run decisions where CVP is used include choice of sale mix, pricing policy, etc. Decision making at the break by the use of break-even analysis. Example, how many units must be sold to break even? That means what is the minimum output at where we will recover the cost and yet not start making profit, but from there onward we are recovering all the cost. How many units must be sold to achieve a target profit? Should a particular order be accepted? And that will depend on a break-even analysis. How much profits be affected if we introduce a new product or a service? The break-even analysis has certain limitations. We are assuming the costs are either fixed or variable, nothing in between. In reality, it may not be possible to put the costs in these two straitjackets. And it further assumes that all along in the whole range of output, these costs can be clearly discerned. Second, the limitation is that we assume is equal to sales, which may not be true. One product is a constant sales mix, or we are producing only one product. We are assuming the selling price remains constant. Which may not be true in cases other than the perfect competition or a very strong monopoly which has a complete control over the prices. In the real world, we sell more only when we reduce the prices. Efficiency is assumed to be unchanged, and volume is the only factor which is affecting the cost. These are the assumptions, or these are the limitations of the assumptions made during the break-even analysis. Then these are the special terms used. The break-even point we have discussed is the point which company makes neither profits or a loss. Contribution per unit is the sales price minus the variable cost per unit. It measures the contribution made by each item of output to the fixed cost and the profit of the organization. Then the term called margin of safety, a measure in which the budgeted volume of sales is compared with the volume of sales required to break even. Marginal cost, as we have seen already at a number of times earlier, is the cost of producing one extra unit of output. Break-even formula, fixed cost upon contribution per unit. Contribution per unit is selling price per unit minus variable cost per unit. Margin of safety is the difference between the budgeted or actual sales and the break-even point. Margin of safety may be expressed in units or in revenue terms. It shows the amount by which the sales can drop before losses will be incurred. So you are better prepared to face the situation. Using the following data, calculate break-even point and margin of safety in units. Selling price is 50, variable cost is 40, fixed cost is 70,000, Budgeted sale is 7,500. Contribution per unit here is 10. 50 minus 40. Break even point 70,000 divided by 10, 7,000 units. So margin of safety is the 7,500 minus 7,000, that is the 500 units. So we are making some kind of a contribution or a profit because we are breaking even at 7,000 units production. We are making neither losses nor profits. What if a firm doesn't just want to break even, it requires a target profit? So how do we find that out? Contribution per unit will need to cover profit as well as the fixed cost. Required profit is treated as an addition to the fixed cost, and here is an example. Calculate the level of sales required to generate a profit of 10,000. Data given is selling price is 35, variable cost is 20, fixed cost 50,000. Contribution is 15. Level of sales required to generate a profit of 10,000 will be the fixed cost plus the profit required divided by 15. So we need to produce 4,000 units to generate a profit of